the biggest story today from the perspective of your finances and indeed for the economy has to be the Reserve Bank of India Governor's announcement this afternoon that the Monetary Policy Committee of the Reserve Bank of India had unanimously voted to increase the policy rates, that is the repo rate, by 40 basis points. And that means that loans across the spectrum are going to get costlier. But that was not all. There was also a move to suck out more liquidity from the banking system by increasing what is called the cash reserve ratio rate, and that was increased by 50 basis points to 4.5%. This is essentially a reserve that banks are meant to keep, and by increasing the requirement for that reserve, and that will kick in on the 22nd of May, the banking system will have less money to lend. So all of this has implications for your finances and indeed for fixed income investments. We're going to discuss all of that in a great deal of detail on this program. But before we get to that, let's first set the context. Let's listen in to some of what the Reserve Bank of India governor had to say during his press conference earlier today.
The Monetary Policy Committee voted unanimously to increase the policy repo rate by 40 basis points, by 40 basis points to 4.40% with immediate effect. Consequently, the standing deposit facility rate stands adjusted to 4.15% and the marginal standing facility rate and bank rate to 4.65%. The MPC also decided to unanimously remain accommodative while focusing on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. The large liquidity overhang in the form of daily surplus funds parked under the SDF has been on an average rupees 2 lakh crore during the month of April. And this has resulted in the weighted average call money rate, that is WACR, which is the operating target of monetary policy, dipping below the SDF. The favorable response of banks, as evident in the bid cover ratio to the 14-day and 28-day VRRR auctions, as well as the US dollar and Indian rupee sell-buy swap auction, which was conducted on April 26th. These also suggest that system-level liquidity remains ample. Therefore, in keeping with the stance of withdrawal of accommodation and in line with the earlier announcement of gradual withdrawal of liquidity over a multi-year time frame, it has been decided to increase the cash reserve ratio, CRR, by 50 basis points, that is 50 basis points to 4.5% of net demand and time liabilities, that is NDTL, effective from the fortnight beginning 21st May 2022. The withdrawal of liquidity through this increase in the CRR would be of the order of rupees 87,000 crore.
Now, I'm sure that quite a few of you who've been following this program will have followed quite a bit of what the Reserve Bank of India governor said. But even if you don't completely understand, don't worry about it. We'll explain it to you in ways that you can understand. Let's first talk about the implications for your fixed income investments, and let's talk about the context and the reason why this has come to pass. My first guest today is Devang Shah, the co-head of fixed income at Axis Mutual Fund. Thank you so much, Devang, for joining in. To say that this announcement today was unexpected would be a severe understatement, coming as it is just about a month after the policy decision, the last policy meet, where there was a clear statement that inflation is, well, it is elevated, but it is under control and it's largely supply side driven. You'd said that perhaps at that time, you'd said that perhaps the Reserve Bank of India is behind the curve. This seems to be a move to rectify that. How would you rate today's move, and how do you explain the context that we currently find ourselves in?
So yeah, Alexi, how I have read today's monetary policies, obviously it's come as a surprise. It's not a surprise to us, it's a surprise to the entire markets as well as all investors. From a perspective on the thought process behind RBI is saying, I think is the inflation concern as highlighted in the monetary policy and the conversation which we also had. I think the focus was that inflation can remain continuously elevated above RBI's comfort zone. The prints which were coming, so last month's print was quite significantly above, it was near 7%, quite above the RBI's comfort zone. I think what we understand is an RBI governor also made a statement about it, is that the April print also continues to remain elevated and the supply chain issues, the crude continues to hover around $100. So somewhere down the line, the near-term prints remains significantly above RBI's comfort zone. What I would say provoked today's move, my understanding is that somewhere down the line, the inflation getting significantly out of control and none of the thing, be it food, be it the components of inflation, be it food, commodities or core inflation, everything continues to remain on the elevated side. I think RBI thought process was that if we are entering into an inflation zone, which seems to be a worry, we should first target at removal of the excesses, as we had highlighted. And I think probably RBI also spoke about this in the April policy, is that they would be targeting the removal of the excesses. The thought process was first narrow the corridor, liquidity absorption, and then the third aspect was rate hikes. So June, I think most of the markets had started pricing in somewhere between 25 to 50 basis of rate hikes. The doing it in probably in May, I think it will just be a messaging from RBI that yes, we are very, very proactive about inflation and we don't want to be significantly behind the curve on the inflation side. So the thought process of RBI is to do a catch up and ensure that they continue to remain not significantly behind the curve on the inflation side.
But there were two big measures if you look at it today, right, Devang? Because you also have to talk about what is going to happen on the liquidity side starting the 22nd of May, which is the increase in CRR. And I was looking at it because I couldn't remember when the last time the CRR was hiked. It is broadly viewed as a blunt instrument to control monetary policy. It was cut, as I understand it, in 2020 and raised again back to 4% in 2021. But how would you explain what this is, first of all, so that all my viewers can understand? And what are the implications of this increase in CRR?
Right. So see, from a banking perspective, I think you mentioned about this. The CRR is a reserve which they need to mention on all the cash balances and everything, which at a particular level, it was 4%. Which they have to maintain on the banking side. And it's a kind of a charge, capital charge, which they need to keep aside in kind of liquid instruments. And they have to maintain this cash at all point of times with RBI. The thought process of RBI to start increasing CRR is somewhere down the line, the humongous liquidity which RBI had infused over the last 2 years, it is actually impossible for RBI to withdraw it. The problem started coming is because inflation is getting out of control. RBI has to take steps to absorb liquidity from the banking system. From 2020, since COVID times, RBI had done huge various measures, including CRR cut, LTROs, OMOs, all kind of tools to infuse liquidity to the tune of 8 to 10 trillion in the system. Indirectly, directly, I think it is significantly higher. At any point of time ever in history of India, we have not seen such kind of liquidity infusion from RBI. In its normal course, generally be it part of currency leakage or RBI operations, the liquidity withdrawal from the system tunes to on an annual basis is somewhere between 3 to 4 lakh crores. At max, 4.5, 5 lakh crores. Now we are at 8 to 10 lakh crores of positive liquidity. We need to move towards neutral liquidity because this excess liquidity is creating inflation. So the worry for RBI is to use tools to absorb liquidity. Obviously, we have had some bit of FX outflows, which led to some bit of intervention from RBI, and we have seen some bit of liquidity absorption. Normal currency circulation, which I explained, will drain out some bit of liquidity by April 23. But if they want to fast pace this, the only tools which they can use is somewhere down the line more of MSS or CRR. Both are tools whereby they absorb the banking liquidity. I think they choose CRR somewhere down the line to start giving a signal to the message to the capital markets as well as banking side that this excess liquidity, which is creating inflation, needs to go back to neutral. Our understanding is, and in fact, I think what we had also read is that one of the deputy governors mentioned about this in the minutes, that most of these excesses, which is in the form of liquidity, corridor widening, as well as rate cuts, which they had done to ensure that economy comes back on track, should be reversed by April 23. I think this is just a step in that direction. They had to neutralize liquidity. CRR is the tool which helps them to neutralize liquidity. The impact of this, I think, is more whenever such tools are used, is more on the short end of the curve, as I think it's limited impact on the long end. So rate hike has more impact on the long end of the curve as well as short end of the curve. It is across the curve. CRR tool is more a liquidity tool, which impacts more the short end of the curve than the long end of the curve.
What I think the central bank tries to do when it's looking at shifting an interest rate policy cycle, right? So you target the short end first, and you benchmark the short end, and then it spreads across the entire curve. But before we get into that, I want to talk about the extent of the increase. You mentioned 25 to 50 basis points, but I think even the bond market, Devang, was expecting 25 basis points. And that, I think, is reflected in the kind of increase that you saw in the bond yields on the 10-year benchmark today as well. This increase seemingly much higher than what people were anticipating. What then are your expectations for the rest of the financial year? You are expecting, of course, policy normalization, but what does that mean? The RBI governor spoke about a 75 basis point cut after the pandemic broke out, and then a 40 basis point cut. So this 40 basis point hike seems to be the first step, like you said, of the reversal. But then what can we expect in the rest of the financial year?
So if you ask me, my understanding is first the RBI will be very fast, and we had spoken about this also post the April policy, is that first RBI will start moving towards those excesses which they had infused into the system, which was this 115 odd basis of rate cuts. 40 basis already done. The balance 75 basis, I think, probably will be done between the June policy and August policy. So our understanding is first RBI will move to the neutrality where they believe so that all the excesses have been absorbed from the system. I think somewhere down the line in April policy, RBI also mentioned about that we should start targeting about positive real rates. Our understanding on inflation is somewhere down the line for the year, it should be, and specifically in Q4, it should be around 5/4, 5/2 on the absolute CPI print. If we're looking at a positive real rate, I think the repo rate from currently, which is 440, can move towards 5/2 to 575. So we are more in the camp by April 23. I think the repo rate can move to closer towards 5/2. So 75 basis is the first reversal, which will happen probably between June and August policies. And post that, we can see another 50 odd basis of rate increases for the rest of the year. That's on the, I would say, on the repo rate hikes. I think the first question which you asked was that is market pricing in 25 or slightly more than 25, or they were not prepared for the 40 basis. I think market was not prepared for this sudden hike, intermeeting rate hikes. What market was penciling in is probably looking at Fed, looking at inflation prints. June is where probably RBI will start targeting a rate increase. And as RBI had probably communicated, it would be a gradual rate hike. I think markets were pricing in between June to August a 50 to 75 basis of rate hikes. This sudden intermeeting rate hike, I think, has come as a surprise. And that is why this entire thought process that June also is a live policy. We can see another 50 basis increase in June policy itself. And hence the market sell-off is more than what market, I would say, the curve was pricing in. The curve was already pricing in more than 25 basis of rate hike across the curve. It is, except for the money side, which is very short end, most of the points on the curve are pricing in 25 to 40 basis of rate increase. It is now the, I would say, the uncertainty that June policy is also live and we can see significant rate increases there. That is creating all the worry and concerns, and hence the sell-off is more.
If I put this in perspective, just to sum up what you've said, is that you anticipate that this is the first step of many. This is obviously a reversal of easy monetary policy and a shift in the interest rate cycle. So from this point, interest rates will only head higher. The question is how quickly, and you anticipate that they will move very quickly in the early part of the cycle. So my next question, therefore, is how does the yield curve move? In that, you've already seen a 25 basis point hike or increase in the 10-year benchmark government bond yield. What happens to the rest of the curve, and how does that progress in the rest of the financial year? Where do we end up? If I ask you where you see the yield curve, both on the long end and the short end of the spectrum, in March 2023.
Right. I think we have been highlighting this, that once the RBI rate hike cycle starts, we start seeing the curve flattening. RBI has also started the liquidity withdrawal. So both the combinations are quite deadly and bad for the short end of the curve. We start seeing a significant curve flattening, and that is what we have witnessed today also, and we will continue to witness over the period of time. Our understanding is that probably the short end of the curve will sell off more than 50-75 basis from current levels, because whatever rate hikes happen, a significant of that gets priced into, or the similar movement happens in the very short end of the curve. So the yield shifting for the short end, which is up to 1 to 2 year assets, can be 75 basis from the current level upwards. The long bonds, as I told you, there's that more macro driven, and somewhere down the line, what is our terminal rates in mind? What kind of, in this cycle, what will be the kind of repo rates which we will see? Where does inflation pan out? What will be the impact of growth on account of all these rate hikes? I think it factors in and takes into account a lot of things. So our understanding is, looking at the current demand supply dynamics, as well as the overall bearishness, or as well as hawkishness on account of higher inflation globally. Uh, we believe that 10-year can touch around 7.5, 775 band and will remain there in this cycle. So probably a 30 to 40 basis increase in the 10-year and long bonds, and specifically around 75 odd basis of increase in the short bonds is what we anticipate over the next 6 to 12 months.
Okay, so not much of an increase. I think you had spoken about it the last time that we spoke also. You said that you don't expect too much of an increase on the long side in terms of yields.
Right.
I do want to also understand then the aspect of the government's borrowing program, which we've also spoken about in the past. In the context of this sharp increase in rates, how does that factor into this conversation, and what's the street? What is the bond market likely to do in terms of that borrowing program?
So if you ask me, somewhere down the line, if you look at the tax collections, revenue collections are all good, but we don't see a significant impact on growth. In fact, RBI also mentioned about this, that despite all these kind of COVID uncertainties, we saw some lockdowns in China for a time being. The impact on COVID has significantly nullified, and actually the growth activities continues to remain quite strong. Giving that, I think on the revenue side, we might see significant bump up in revenues, and we don't see any major shortfalls. From a gross borrowing program at this point of time, we don't see any kind of major deviations, or in fact, any kind of significant increase in borrowing. The absolute levels where you can tend across on a demand supply dynamics, I think a lot of negatives are already in prices. Obviously, yes, the pace of rate hikes has increased. The pace of rate hikes can be faster. So near term, we can see volatility. We can see 10-year bond yields hovering between 7.5 to 775. But I think at 7.5 to 775 band, you will see a lot of investor demand started creeping in. And we don't see significantly levels going beyond those levels. Investor demand as well as overall borrowing program between these levels should be able to sail in.
With that in mind, then, I want to talk about strategy. And we've been talking about fixed income strategy over the past couple of policy meetings. And, I want to know whether that changes at all. And how does one factor in this sharp increase that is out of cycle policy increase? What should the retail investor who wants to have a fixed income portfolio bear in mind when they're constructing or maybe shuffling their portfolio as we speak?
So Alex, I think the for us, like it's very clear that at this point of time it is uncertain. You have a Fed meeting tonight. We know all somewhere down the line it's an RBI surprise, okay, and somewhere down the line this is just the beginning. As RBI has highlighted itself that we have to remove the excesses. The 75 basis of rate hikes will happen even if it is two policies. It is next two policies. The 75 basis of rate hikes will happen. So investors at this point of sight should continue with the short end of the curve. Okay, I think the repricing of assets keep on happening. They're generally very short on duration, up to 6 months assets. We don't see any kind of big impact there on account of rate increase also. So I would say liquid to money market funds is what investors should invest at this point of time for the time being. Once a couple of policies are behind us, I think probably these excesses are reversed. We would have the 10-year probably above around 7.5 or above. We would have the short end of the curve, which is the 2 to 4 year segment, also probably 40-50 basis higher from current levels. Today, that I think from its bottom, the 3-year corporate bond, which was in just last year, April 21, which was at 5%. Today, the 3-year corporate bond would, if there is a supply or a new issuance comes across, I think probably it will be upwards of 675. So we've already seen a 175 basis kind of a sell-off. I'm talking about another 50, 75 basis of sell-off by the next two policies. At 7/4, 7.5 band, I think investors will start looking to enter duration. So currently, just park yourself in extreme short end of the curve. After the couple of policies, I think probably start looking at short to medium term funds because most of the pain is behind us. Our understanding is that such RBI done the right step because RBI being proactive in ensuring that inflation doesn't go out of control can lead to some bit of impact on growth, but on a medium term, it actually ensures financial stability. So from a perspective on rates, we don't see a significant blow up in rates. I would have been worried if RBI was behind the curve. RBI has been proactive. So in this cycle, I think somewhere down the line, if RBI is trying to tame the inflation to ensure that we don't see any kind of financial stability hiccups, we don't believe so that you would see massive sell-off. Currently, just park yourself in the short end of the curve. Once the reset happens in the next two policies, you should start looking at short to medium term funds.
I have one. How does this change your own in-house expectations of how inflation will pan out? Do you think that the measures taken today will serve to curb inflation? And I think to a certain extent also, Devang, this is an admission that the inflation print is not just supply driven. There is quite an element of demand side push also to inflation that I think is being addressed with the increase in policy rates. So what is your expectation on that front? And do you think that a downside risk to growth or the possibility that growth could get impacted because of this policy measure could weigh in on future policy decisions?
See, my understanding is as of now, RBI is removing only the excesses which they built in over the years. Okay, so I don't see these steps, the current monetary policy, today's monetary policy steps to at any point of time to have massive impact on growth. These are steps which RBI had taken in an extraordinary environment. CRR impact is 87,000 crores. I think overall banking liquidity is still very, very positive. This is just withdrawing that 1 lakh crores of liquidity approximately to start going back to neutral faster than anticipated. So at this point of time, if you ask me, current measures which RBI has done, we don't see a major impact or weighing that on the growth massively. If you ask me, our thought is that somewhere down the line, this kind of inflation generally starts creeping into reduced demand. And you should start seeing some bit of impact of that on the growth, but it comes with a lag. It is not going to happen immediately. Today, we have these last 2 years where I think consumers have not spent, consumers have not gone out. Plus there has been a good wealth as well as income effect where savings rate for investors and consumers have massively increased. So our understanding is the growth impact will not be immediately, but if you ask me, if Jan to March 2023 or the print of growth in H1, calendar year H1 2023 is where we start seeing impact on growth. Currently, I think RBI, and that is the way it always works, when inflation goes out of control, the first few policies you start believe RBI will be faster. All central banks does that. The central banks will be faster or the pace of rate hikes will be faster. And then probably in second half, I think probably RBI will start looking at the impact of that on the growth. So from a growth cycle perspective on FY23, which is April 22 to March 23, we don't see a major impact. I think the impact on growth will come in FY24, and RBI will start taking cognizance of that probably in the second half of this year.
I think we've summed it up very nicely, and we are in fact going to continue to talk about that. Part of what you mentioned, of course, has to do with real interest rates, which is very important from the perspective of the individual, and we will talk about that. But thank you so much, Devang, for laying the context for that conversation. Thank you so much for taking the time.